Good morning, everybody. Hope the week is treating you extremely well. Not a whole lot has changed since we spoke last week. With the S&P 500, we are grinding higher. We are in this major resistance zone, that 2750 to 2820. If we can clear that, then we've got a shot back towards those all-time highs. But this is the zone that we've been talking about now for months, where the market, if we were to bounce back up here, should have some problems getting through. We should at least maybe get a grind sideways here for a little bit. If we're going to make that next pop up, it would be very rare for us to just straight continue just pushing straight higher through it. Now, there is one technical change that we do have here on the charts. RSI reading is now over 70, which is right here. Now, being over 70 is not, it doesn't mean, oh no, we're overbought and, we need to worry about things. The way I use RSI is we pay attention for when we go from above a 70 reading to below a 70 reading. That's when the cautionary tale essentially plays out for me. We can stay over 70 for a long period of time. If we go back to the beginning of last year, you can see here's the breakout of RSI right here at 70, and the market proceeds to go up for the next month, and RSI clearly stays over that 70 zone. So, we go up another 7% at that point in time. Now, when we break below 70 right here, that's right here, and that's where you get that cautionary tail. So I would watch for that action from being above that 70 RSI reading to falling below it. But just because we're over that 70 RSI reading doesn't mean anything negative. Now, we put the S&P chart aside here for a second. We're going to take a look at a couple of interesting things Sentiment Trader has put together. One of which I wanted to address was the breakout last week in a high-yield bond index. Now, I saw a lot of people talking about this in a very bullish manner, like high-yield bonds are going up. That can't be bad for the market. That's all signs clear. We should continue to grind higher. Well, when you go and you actually backtest the numbers, the sample size is very small. It's only 6. But when the S&P is 5% or below multi-year highs and the bond index makes a new high in the last 20 years, in the last 30 years, that's only happened 6 times. It has been a negative for the S&P 500. It has actually been a better sign for the high-yield bonds themselves. But the S&P 500 over the next month is only up a third of the time, and the average pullback was 8% a month out, and the average upside was 0.2%. Now, why is that? Well, bonds were making those pushes higher during the early 2000s, when we were making that major pullback over those the dot-com bubble collapsing, and the S&P continued to roll over and yields continued to make new highs, and that is part of the reason why this is so net negative. It also happened in the early 90s as well, and the couple of times that it was positive were later in like 2009 and 2012. So this in and of itself is not a reason to get extremely excited or extremely pessimistic either way, because again, the sample size is too small. But just because high-yield bonds made a new high doesn't mean necessarily good things for the market itself. And so I just really wanted to point that out real quickly. What I really wanted to discuss was what was very cool is that we can actually take a look at the market that we have had here over the last 100 days and compare it to the highest correlated periods of price movement, and we can stack those on top of one another, and we can take a look at where we are and where the average move from a move that we have just made ultimately ends up playing out. And I want to talk the technical reasons of why I believe that this ultimately plays out like this. We're the blue line, and the highest correlated average periods are the black line here on the chart. So you can see we followed it pretty decently. But you'll notice we start to roll over here, and we start to go back towards testing those lows, right? And you can see on average we test those lows that we put in about 60 days into the cycle. We end up testing them at about that 140-day period. Why is that? Well, just like the current market that we've got right here, we make a huge pullback and we make a bounce, and the bounce goes right into where? Into resistance. And you can see the same thing on this chart, right? We go back and we test where we broke down from. And that typically takes about 100 days in order for that to play out. And then we get that rollover to test those lows over the next 1 or 2 months. And then the majority of the instances were actually higher if you go out another 80 to 100 days from where we're at right now, right? We go back, we test the lows. If the lows hold, right, then we tend to come back up and we end up breaking that high. So let's actually look at the individual instances themselves here. And so the first one on the chart is where we broke the lows and we didn't come back, right? This is 2007. We came back, we tested those lows, it broke, and then we rolled over. Now, go back to 2014. We came back and we tested those lows. We actually didn't break down here. We actually pushed higher. In 2000 and it's not 2014. This was 2001 back here, guys. I'm sorry. In 1990, we came back. We back tested right around that 120 day, and then we pushed higher. 1981, it took to 180 days for us to get that double bottom test, but then we pushed higher. 77, about that 140 day period, we got that test, and then we pushed higher. 1974, it actually happened at about 120 days, and then we pushed higher. 71 happened at about 140 days. We pushed higher. 1969, we broke the lows and continued to push lower. 68, we broke those lows and continued to hold lower. 1953, we came down and we tested those lows and we bounced. So really, when we go and we look at this right here, it's do we come back and test the lows and do those lows hold? That is on average what we have done. In the past, any time that the price action has taken a very similar action to what we've done. Now, on this page, anything that's correlated of 0.82% or higher since 1928 to 2019 has showed up here on this chart. And what we can see is 6 months later and a year later, right, it's a net positive, right? It's a small positive, only 50% of the times are positive. 6 months later, a year later, 60% of the time. And there's a pretty decent number of instances of this happening. But between 1 and 3 months, the majority of the time we are net negative, and we're net negative in a large way. We're down 7%. On average after 2 months, down, after 3 months, 11%. And again, the reason for that is not that we completely collapse, the market completely collapses, that it usually retraces this move. And if we go back even in recent times to sell-offs that we've had, the beginning of last year, right, we got that nice bounce. And if you go from where we originally started selling off, it happened in about 70 days where we topped out. 70 to 100 days is that range. And what did we do? We came back and we tested those lows. They held. We pushed higher. We go back, further in time here. Let's go back and look at some weekly charts, right? We came in here, and if we look at the days, we came down, we made our bounce, we tested those lows, it held, and we pushed higher, right? We came in, we made our bounce, we tested those lows, we pushed higher. The majority of the time it tests those lows, but not always. If you go back again to 2014, we pushed straight down and we just pushed straight up and we just made new highs. And we never actually tested those lows until over a year later. And we came back and tested that zone again. The point that I'm trying to make here is, right, we have seen an amazing run up since December. We are at a resistance zone. The market, the RSI is over 70. Again, that doesn't mean that that's a bad thing. It's just an area of concern if we fall back below 70. And on an average cycle, we're right about that period of time where the market tends to, for the next couple of months, pull back to retest those lows. I still think that that is probably the highest probability chance that we have here, is that we do get some sort of pullback here over the next couple of months to make a test. And we may not get all the way back to these lows. We may only get, maybe back into this zone here. But we should, the market should back test. It's very difficult for us just to continue straight up. Right? Market tends to work in waves. We had a big wave down. We have made our nice wave bounce back up. And that's typically, when we look at the last 30 instances of this happening, we typically will tend to make that pullback. All right. If we do make that pullback, then we're going to be paying attention to the bottom end of this zone. And really the zone of support, if you guys want this put on the chart, is actually from here down. This whole area, in my opinion, is actually a zone of support. It's actually much larger than this zone of resistance that is up here. And that's because, all right, we had support. The support zone starts from back in here. We tried to hold a couple of times. And then the reason why this is so big is because we had such a violent sell-off and that immediate subsequent bounce higher. So on a technical basis, we could come back into any portion of this zone and make our bounce, and that would be fine. If it violates this low, then of course that would not be the case. So as we're paying attention moving forward, paying attention to this 2820 level, if we can get above this, then we can kind of push all this aside. Say that we have certainly done something that we usually do not do. We have just straight V rallied and pushed all the way up to highs. It has happened in the past. The majority of the time, we should see some sort of resistance play out here over the next couple of months and a pullback into this zone of support. If we do that, we're going to watch this major zone of support for ultimately our next decisions. Hope you guys have yourselves a fantastic week. As always,